Permanent life insurance is basically the mirror image of term. Term life says, I'll cover you for a specific window of time, and I'll do it for the lowest cost possible. Permanent life says, I'll cover you for your entire lifetime, and we're going to add some extra features along the way. So what are those extras, and why do people pay so much more for them? That's what this episode is here to unpack. Welcome to Wiseside Life and Legacy. I'm Nakel Nakima, and this is episode 9, Permanent Life 101, Whole Life, Universal Life, and Variable Universal Life Explained. Season 2 was all about term insurance. We broke down what it is, how to choose the right length, the variations you'll see in the real world, a few stories that make it feel real, and the questions people ask when they're trying to decide. If you followed Season 2, you should feel solid on term. Now in Season 3, we move into permanent insurance. And I'm going to be honest with you up front, permanent life is more complicated than term. It's not complicated because it's a scam or because it's impossible to understand. It's complicated because it's doing more than one job at the same time. Permanent life insurance is designed to last your entire life. It includes a cash value component that can grow over time. It can potentially be used as a financial tool. It also costs a lot more than term. And depending on who you are and what you need, that higher cost can either be totally unnecessary, or it can be exactly the right move. In this episode, we're going to do a true overview, the 3 major categories of permanent insurance, all in one place. Whole life. Universal life. Variable universal life. For each one, I'll walk you through what it is, how it functions, what's happening with premiums and cash value and death benefit, the real pros and cons, and the kinds of situations where it tends to make sense. Then in episodes 10, 11, and 12, we'll go deeper into each one. Before we split into the 3 types, we need a clear line between term and permanent, because if you don't get that difference, everything else becomes blurry. Term insurance is pure protection. You pay a relatively low premium. If you pass away during the term, your beneficiaries receive the death benefit. If you outlive the term, the policy ends. There's no cash value account attached. There's no built-in savings. It's basically renting a death benefit for a specific amount of time. Permanent insurance has 2 layers. Layer 1 is protection, you still have a death benefit. But the key difference is that the coverage is designed to stay in force for your entire lifetime as long as you keep the policy funded correctly. Layer 2 is the financial component, part of what you pay can build cash value over time. That cash value can be accessed in different ways, and it comes with tax advantages that we'll explore in more detail later in the season. So here's the trade-off, and you'll hear it over and over, term is cheaper and simpler, but temporary. Permanent is more expensive and more complex, but it can be lifetime coverage and it can build cash value. Alright. Let's start with the oldest, most familiar permanent product, the one most people picture when they hear the words, life insurance. Whole life. Whole life insurance is the classic permanent policy. It's been used for generations. The core pitch is stability. Typically, you pay a level premium, meaning the premium is designed to stay the same year after year. The company guarantees a death benefit. And it also guarantees that cash value will build over time, usually at a modest, steady pace. This is why whole life is often described as predictable. It's meant to be steady and reliable, not exciting. The cash value growth is usually in a guaranteed range that's not huge, often something like 1 to 3% in simplified explanations. In the real world, there can be additional factors like dividends on certain policies, but the big theme is, whole life emphasizes guarantees and structure. Let's ground it with an example. We'll use a consistent character so we can compare across products. Imagine David Carter. David is 38 years old. He wants $500,000 of coverage in a permanent policy. If David buys whole life, the premium is going to feel heavy compared to term. A simplified example might put him around $10,000 per year, roughly $800 per month. Again, the point isn't the exact quote, the point is the magnitude. Whole life takes a bigger payment because it's funding lifetime coverage and cash value accumulation. Each time David pays a premium, the money doesn't all go to the cost of insurance. Some of it funds the actual insurance protection, some covers the insurer's expenses, and some is allocated to build cash value inside the policy. The cash value is like an internal account that gradually grows. So you might hear a simplified illustration like this: out of David's monthly payment, maybe about $150 per month is effectively building cash value in the early years. Over time, as the policy matures, the cash value can grow into something meaningful. After 20 years, maybe that cash value is in the neighborhood of $35,000 to $40,000 in a simplified example. After 40 years, it could be $150,000 or more, depending on the specific policy design, assumptions, and how long he keeps it in force. Now, an important detail: when David dies, the policy's death benefit is paid to his beneficiaries. In this example, that's the $500,000. Meanwhile, during his life, David may have access to the cash value. Typically, this access comes through policy loans or withdrawals, depending on the structure. Loans are common in these conversations because you can borrow against the cash value while the policy remains in force, but loans have rules and interest, and they can reduce what's left for beneficiaries if not managed well. So why do people like whole life? The biggest reasons are guarantees and simplicity. With whole life, the premium is generally level. The death benefit is guaranteed. The cash value growth is guaranteed at a baseline level. It's not something you're meant to actively manage every month. It's stable, predictable, and built for long-term planning. Whole life also comes with favorable tax treatment on the growth of cash value inside the policy, and it can be used as a form of forced savings because you're committing to a payment schedule. But you have to respect the downsides. First, cost. Whole life can be dramatically more expensive than term for the same death benefit, especially at younger ages when term is very cheap. People see that jump from, say, around $60 per month for term to hundreds of dollars per month for whole life, and they immediately ask, why would anyone do this? It's a fair question. Second, growth speed. Whole life cash value growth is generally slow compared to what you might be able to earn if you invested consistently in the market over decades. Whole life is not trying to be the highest return investment. It's trying to be a stable insurance-based asset with guarantees. Third, flexibility. Whole life policies are typically not designed for constant adjustments. You're committing to a structure. If you're the kind of person who wants to tweak and optimize and change your payment amounts frequently, whole life can feel rigid. So who tends to buy whole life? Often it's someone who wants a guaranteed death benefit that does not expire, someone who values predictability, someone who wants the discipline of built-in savings, and someone who has the cash flow to handle the premium without squeezing their other financial priorities. Now let's move to the next category, universal life, often shortened to UL. Universal life became popular decades after whole life because it offered something whole life didn't: flexibility. Universal life was essentially designed to say, what if we keep the permanent coverage and the cash value concept, but we allow the policy owner more control? Control over premiums, and sometimes control over the death benefit structure. Here's the basic idea. You pay premiums into the policy. The insurer deducts the cost of insurance and certain expenses. The remaining amount builds cash value. And that cash value earns interest, typically at a rate that can change over time. The rate might be influenced by market conditions or the insurer's performance, depending on the specific UL design. The big headline feature is this: with universal life, the premiums can be flexible. That doesn't mean you can just pay whatever you want whenever you want with no consequences. It means the policy is structured so that, within limits, you may be able to pay more in some years, less in others, and in certain situations even use accumulated cash value to cover costs for a period of time. So let's go back to David. He's still 38. He still wants $500,000 of coverage. Suppose David buys a universal life policy with that same death benefit. In a simplified example, the initial premium might look lower than whole life. Maybe around $500 per month instead of $800 per month. But here's the catch, and you have to hear this clearly, that premium level is not always guaranteed the way whole life is. Universal life pricing and long-term policy performance are connected to assumptions. Interest crediting rates. Cost of insurance charges. Policy expenses. How the cash value performs relative to the illustration. All of that matters. So when people say universal life can be cheaper, what they often mean is cheaper at the start, under certain assumptions. Over time, as you age, the cost of insurance generally increases. If the cash value doesn't grow as projected, you may need to pay more later to keep the policy in force. That's why universal life requires attention. Not daily attention, but periodic check-ins. You can't put it in a drawer for 30 years and assume everything will be perfect. Let's talk pros. 1. Universal life gives you flexibility, which can be helpful for people with uneven income. You can potentially adjust payments when cash flow changes. 2. It may offer lower initial premiums than whole life. 3. The cash value may have more upside than whole life in some scenarios because the credited interest rate can vary. Now cons. 1. Fewer guarantees. You're trading certainty for flexibility. 2. Complexity. You have to understand at least the basics of how the policy stays funded over time. 3. Monitoring. If things drift away from the original assumptions, you may need to course correct. If you don't, the policy can underperform and potentially lapse if it's not properly funded. So who tends to buy universal life? People who want permanent coverage but don't love the rigidity of whole life. People who think their income may rise over time and want the ability to pay more later or build the policy strategically. And people who are comfortable with the idea that they'll need to review the policy periodically, because universal life is not, set it and forget it, in the way whole life often is marketed. Now we move to the most aggressive and investment-linked version of these three, variable universal life, or VUL. Variable universal life keeps the universal life framework, permanent death benefit plus a cash value component, with flexibility around premiums. But it changes one major thing. Instead of your cash value earning an interest rate determined by the insurer's crediting method, the cash value is invested in market-linked subaccounts, which function a lot like mutual funds inside the policy. This means you, as the policy owner, typically choose how the cash value is allocated. You might have options like stock funds, bond funds, balanced funds, international funds, maybe real estate-related funds, depending on what the policy offers. And the cash value rises or falls based on the performance of those investments. This is the risk and reward trade, and it's the entire point of VUL. Whole life aims for slow, steady, guaranteed growth. Universal life aims for flexible funding with interest that can change. Variable universal life aims for higher potential growth by taking on market risk. Back to David again, 38 years old, $500,000 coverage. In a simplified example, the initial premium might still resemble universal life, maybe around $500 per month to start. But now, what happens to his cash value depends heavily on market performance and his investment choices inside the policy. If he allocates to a growth-focused stock fund and the market does well, his cash value could increase significantly, maybe he sees years with 8% or 10% growth. But if the market drops, his cash value can shrink. And if the cash value shrinks too much, that can create pressure on the policy's ability to sustain itself without higher premiums. So let's do pros first. VUL has the highest upside potential for cash value growth among the three, because it's tied to market returns. It can appeal to someone who wants permanent insurance but also wants a market-exposed asset inside the policy structure. It also offers choice and control over allocations, which some people value. Now cons, and these matter. Market risk is real. Poor performance can reduce cash value. That can force you to pay higher premiums later, especially as insurance costs rise with age. If someone buys VUL with unrealistic expectations and then ignores it, the policy can become a problem. Also, it's the most complex of the three. You're combining insurance mechanics with investment management. That requires attention and some understanding, or at least a commitment to getting good guidance and reviewing it regularly. So who tends to buy variable universal life? Usually someone who wants permanent coverage and is comfortable taking investment risk. Someone who either has investment knowledge or is willing to treat the policy like something that needs oversight. And someone who understands that more upside also means more ways it can go wrong. Alright, now that we've laid out all three, let's put them side by side and build a simple decision framework. Same person, same age, same death benefit, David, 38, $500,000. Whole life in our simplified comparison might look like roughly $800 per month. The premium is designed to be stable. The death benefit is guaranteed. The cash value growth is guaranteed at a modest rate. It's easy to understand relative to the other two, and it's designed to be steady. After decades, you might have meaningful cash value, maybe around $150,000 after 40 years in a simplified example, but the emphasis is stability, not maximum growth. Universal life might start closer to $500 per month. It aims to be more flexible and may be more cost-effective in the early years. But the premium is not necessarily locked in the same way. Cash value growth depends on the credited rate and the policy charges over time. It can potentially outperform whole life in cash value, but it can also disappoint if assumptions don't hold. In a simplified example, after 40 years, the cash value might land somewhere like $150,000 to $300,000, but there's more variability because it's more dependent on performance and funding decisions. Variable universal life might also begin around $500 per month, but now the cash value is tied directly to market subaccounts. That means the range of possible outcomes expands dramatically. After 40 years, you might see a large cash value, potentially hundreds of thousands, even up to 7 figures in an aggressive scenario, but you could also see far less if markets perform poorly or if the policy isn't managed and funded appropriately. The upside is highest, and the risk is highest. So how do you choose without getting lost? Here's a practical way to think about it. Question 1. Do you need permanent insurance at all? Because a lot of people don't. If the goal is to cover income replacement while your family depends on you, cover the mortgage years, protect kids while they're growing, or replace what your savings hasn't built yet, term insurance often does that job cleanly and cheaply. Permanent is not automatically better. It's just built for a different purpose. Question 2. If permanent does make sense for your situation, what matters more to you? Guarantees and simplicity, or flexibility and higher potential growth? If you want the least moving parts and the highest predictability, whole life often fits that preference. If you want flexibility and are willing to monitor the policy, universal life becomes a contender. If you want maximum upside and you're comfortable with market risk and complexity, variable universal life may fit. Question 3. What can you truly afford consistently? Permanent insurance is a long-term commitment. It's not just about being able to make a payment this month. It's about being able to fund the policy for years and years while still investing, saving, and living your life. If the premium crowds out your emergency fund, retirement contributions, or the basics of your financial plan, it's probably not the right time or the right product. That framework alone will eliminate a lot of confusion. And it helps you avoid the most common mistake people make, buying permanent insurance without being clear on the job it's supposed to do. Now here's where we go from here in the season. Today was the wide-angle view. Next, we zoom in. Episode 10 is a whole life deep dive. We'll get more specific on mechanics, how cash value really works, the tax angles people talk about, when it genuinely makes sense, and examples of real use cases. Episode 11 is the Universal Life Deep Dive. We'll talk more about how interest crediting works, why monitoring matters, what can cause a policy to drift off course, and how people use UL when flexibility is the priority. Episode 12 is the Variable Universal Life Deep Dive. That's where we'll spend time on the investment side, risk management, what it means to have sub-accounts inside an insurance policy, and how to think about VUL if you're comparing it to investing outside of insurance. Let's close with the main takeaway I want you to remember. Permanent insurance isn't superior to term. It's not a status symbol. It's not automatically the grown-up version of life insurance. It's a tool designed for different problems. Term is often the right tool when you need affordable protection during the years your absence would be financially devastating and your responsibilities are highest. Permanent can be the right tool when you want coverage that doesn't expire, when you want to build a financial asset inside the policy, when you're thinking about leaving a legacy, or when you're planning for a future where health changes might make new coverage difficult or expensive. So here's your simple action for the week. Ask yourself, do I actually need permanent insurance? Do I want coverage for my entire life, or do I mainly need protection for a season? Am I trying to build cash value intentionally, or am I more focused on maximizing affordability and investing elsewhere? And is legacy a major goal for me? If your answers point you toward permanent coverage, then episodes 10 through 12 will help you sort out which type is most aligned with your priorities: whole life, universal life, or variable universal life. I'm Nakel Nakima. This has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy. I'll see you next week for the Whole Life Deep Dive.